Welcome to the deep dive. Today we're digging into something pretty interesting. The investment strategy we can see from Nancy Pelosi's publicly available disclosures.
Yeah, and the numbers reported for 2024 really catch the eye. A 70.9% return, that's quite a bit higher than the S&P 500's, 24.9%?
Exactly, significant outperformance.
Now, it's worth pointing out for you, as investors listening, that the disclosures show these investments are primarily managed by her husband, Paul Pelosi.
Right, but the strategy itself, the patterns you can observe, are still noteworthy.
Definitely. So our goal here isn't commentary, it's observation. What can we learn factually from this activity that might be relevant for your own investment thinking?
Okay, so first up, what really jumps out is this heavy focus on technology companies.
Yes, a very concentrated bet, it seems, and specifically within high-growth tech. If you look at the holdings around early 2025, the big names are there. NVIDIA, Apple, Microsoft, Broadcom, Alphabet.
It really looks like a strategy aimed at, riding the long-term waves, betting on the winners in massive shifts like AI, cloud computing.
And the chips that power it all. Absolutely.
Take NVIDIA. That was reportedly the largest holding in 2024.
And there were significant purchases noted mid-year. So for any investor looking at the AI landscape, NVIDIA's role is central. This allocation really underscores that view.
And even with Apple, okay, some shares were apparently sold late in 2024, December time.
Right.
But it seems likely it remained a top holding. Suggests a belief in its sort of enduring value, maybe.
Seems plausible. Same story, kind of, with Microsoft. Still in the top 5, despite some sales back in July 2024.
Right.
These are the established giants.
And Broadcom fits that theme, too, right?
Yeah.
Especially with AI infrastructure.
It certainly seems to align. There was mention of it based on, I think, a social media post from mid-2024, suggesting its relevance there.
Okay.
And Alphabet, Google's parent company.
Yeah.
Despite selling some earlier, there was new option activity in 2025. So still looking positive on it, it seems.
Right, so a clear tech focus.
Right.
But it's not just buying and holding stock, is it? There seems to be a lot of activity with options.
Yes, that's the next layer here, and it's quite sophisticated. There's frequent use of call options, often deep-in-the-money ones, or, importantly, long-dated options.
EDs.
LEPS, right. Long-term equity anticipation securities. So options, but with expiration dates way out, like a year or more.
Exactly. And the benefit for an investor? Well, it's about capital efficiency, potentially. You can get exposure to the stock's potential upside.
With less capital tied up compared to buying the shares directly. Leveraged gains, potentially.
Precisely. And look at the timing reported in January 2025. Purchases of long-dated calls on NVIDIA, Alphabet, and Amazon.
All right.
All expiring January 2026, so a year out.
Okay.
And with strike prices below where the market was, that suggests, a longer-term bullish conviction.
Interesting. And then there was that VistaCore option purchase. That felt a bit different. Yeah, that looks like more of a thematic play. Something for investors to notice, connecting the dots between AI growth and the sheer energy needed for data centers.
So betting on an energy provider that could benefit from that massive demand.
That seems to be the angle, yes.
And we should mention Tempus AI. Those options reportedly did incredibly well.
Oh, definitely. Bought at $20, apparently, and nearly tripled after the IPO. And that kind of quick, significant gain always gets attention.
No kidding.
And it seems the Broadcom call options, the ones from mid-2024, are still being held, just adjusted for the stock split. So continued conviction there, too.
So tech concentration, strategic options. The sources also talk about a core plus satellite structure. What does that mean in this context?
Well, think of it like this for your own portfolio construction, perhaps. You have a core, usually larger, maybe more stable, long-term investments.
It's like the NVIDIAs, Apples, Microsofts we talked about. Foundation.
Exactly. And then you have the satellite portion. This is where you might put potentially higher growth, but maybe more speculative or volatile assets.
Okay, so higher potential returns, but maybe more risk, or perhaps they're less liquid, harder to sell quickly.
Right. And the examples cited here fit that. Things like a private equity stake in Databricks, noted in March 2024, that's tied to generative AI again.
But it's a private company, not traded on the stock market.
Correct. And also a private real estate investment mentioned, REOEOFXD6, focused on the San Francisco tech sector. And you could argue those Tempus AI options pre-IPO were definitely in that satellite category.
Got it. Core for stability, satellite for that extra growth potential. Finally, there's this observation about timing. Trades sometimes happening around policy events or market shifts. We need to be careful here, just state the facts presented.
Absolutely. Just reporting the observation. The example given in the sources is the sale of Visa shares back in mid-2024.
And that happened around the time a proposed regulatory draft about the credit card industry came out.
That's the reported timing, yes. It's just an observation about correlation, not causation. All publicly disclosed, of course.
Okay, so let's try to pull this together. If you're an investor watching this, what are the key observations, the potential takeaways from all this public data?
Well, one clear observation is the strong focus on major, foundational technological trends, AI, cloud, EVs, data centers, and betting on the perceived leaders in those trends.
So a major trends plus leaders approach. Identify the big shifts, pick the key players.
Seems like it. Think about NVIDIA's weighting. It suggests looking for those kinds of pivotal companies in whatever major trends you identify.
Makes sense. What else?
The way options are used, particularly LEPS, it suggests a method for maybe leveraging a long-term positive view without committing huge amounts of capital up front.
Especially buying them when the market dips, perhaps, getting in low on a long-term bet.
That seems to be a pattern, yes. Using those longer-dated options strategically. Something for you to consider if you have strong long-term conviction on a stock.
And the mix of assets, going beyond just stocks.
Right, the private equity, the real estate. It suggests thinking about the whole ecosystem around a trend, not just the public companies. Now, direct private equity might be hard for many.
Sure.
But maybe you look at ETFs or other funds that give some exposure to those broader themes or private markets, if appropriate for you.
And lastly, despite all the options trades and other moves,
the core holdings, those big tech names, seem to be held for longer periods. It suggests a focus on long-term growth for the core portfolio, not just constant churning.
So strategic adjustments rather than frantic short-term trading for the main part of the portfolio?
That appears to be the approach observed, yes.
Okay, so to wrap up, the observations point towards a strategy centered on concentrated tech bets, using options cleverly for leverage, a kind of core satellite structure blending stability and growth shots, and maybe keeping an eye on market-moving events, all based on those public disclosures.
Which leads to, I think, a good final thought for you, the listener, as you process this. Thinking about these publicly observed activities, what potential adjustments, if any, might you consider for your own strategy when it comes to spotting and acting on long-term growth trends?